afternoon, everyone. It is my time with you, one-on-one, right? One-on-one. Obviously, because you're looking at your device, you're with me one-on-one. So we have this series we are doing to move or not to move, right? Which is comparing each state from this state to another and how things are going. And you can search our YouTube channel, and then you'll see the other ones we talked about. So far we covered, I think we covered Iowa to Texas, California, Texas. Today we're covering Iowa versus Wisconsin, because these are Midwest states, right? So generally people will say not much difference, which is not wrong by saying that. But our goal is to really break it down in such a structure that, and make you see it really clearly, and what benefit and drawback you have if you move to one place to another from tax standpoint of view. Tax is really not everything in life, right? So in life, two things we cannot avoid. Of course, one of them is tax, or the other one is you die, right? People always say that these two things are definite. But however, this tax can be severe, can be different, right? So you work on that aspect. Even death can die easily, can die hard, can be shot 10 times for no good reason. So, so those are the things. When we talk about move or not move, we just focus on taxes here. It's really not meant for you to make decisions just by what we're talking about here. And I would like you to make decisions based on why you really want to move. Maybe because you like the governor better in one state than the other. Or maybe you like your relatives are all in one place or another. So there's other reasons, right, to move or not to move. So let's get going with Iowa and Wisconsin. Before we go on to our content, I always spend less than a minute to tell you about our firm. So communitycpa.com is our website. If you click contact button there, you will come to this one. You can send us message, or you can make appointment with us, on board with us, all kind of things. And we continuously improve our interface. So if you go to on board with us, a year ago, it's different interface than today, because based on clients' comments, we keep on, updating what we have. Another thing is the YouTube channel. You already know that's how you find me, right? Make sure you subscribe to our channel. And also when you look at our videos, give us a thumb up if we deserve it, because the thumb up, the subscribing, those actions will give our channel a little bit of lift in this massive AI world. So when you go onto AI searching for anything or Google searching for anything, if a lot of people subscribe to our channel, then our channel content will come out for searching. People will get an answer. Oh, because Ying had a slide talk about mark to market, so people will find. And we have related to earned income, the ERC, employer, I even forgot what was the stands for, but ERC, retention credit, something. The ERC, the mark-to-market asset protections are kind of important search for our site. A lot of people are looking at that. I know the asset protection is getting heavier just because there's so much uncertainty right now. Either business owners are struggling, or maybe they got deported, or family are not stable, and just a lot of tension right now. So protecting your asset and knowing what you're doing is fairly important. And of course, I have 2 books written, and I have 2 more to come. And this is no responsibility disclaimer page where we want you to take responsibility for the knowledge you learned and make sure you use them wisely, right? You can get a lot of knowledge out on internet, but not all of them are right. So just make sure you're aware of the sources where you get the information. When we view of move or not move, we have these 5 categories regularly. As a tax person, when someone goes, oh, Ying, I want to move to New York. And then these are the 5 things automatically programmed in our mind. So we will immediately think about personal tax, business tax. You know, most of our clients are business owners, so we naturally just go on business. Because even though we do 1040 return here, but we really just do that with your business. When you have a business, we will do your 1040. But if you don't have a business or just 1040 filer, we would recommend you to some places that may be free, or, you know, obviously it doesn't have the complexity, so it should be done for very low price. So that's where we are going to send those folks. But people with businesses, especially successful business, and you felt you're paying taxes left and right, you almost need to borrow money to pay taxes, you are my client. So just remember that. And then, of course, when you move or not move, other than business and personal income tax, you also want to consider sales tax, because that is your everyday thing, right? You want to consider property tax, and you want to consider estate and inheritance tax for the state, because you're gonna die. You either die this state or that state. I'm pretty sure you're not gonna die on Mars, so we still have to consider your tax consequences, right? Residence and exit plan is also important. Just say, oh, I moved. It's not that simple. You really need to figure out, you know, whether you had the proof that you moved. So your residence state can tax you properly, and your other state which you moved out of, that should only charge you partial or not charge you at all. So with that said, let's go to personal income tax. With personal income tax, Iowa, like I mentioned before, since as of tax year 2025, so this right now we're doing 2025, right? So from now on, Iowa has this flat rate of 3.8%. Very simple, right? Doesn't matter how many million you make, doesn't matter how many thousands you make, and your rate is the same. And under the current law, right now the 2025 adjusted to 3.8%, and the rate is scheduled to adjust to be 3.9% beginning in tax year 2026. So when we are in 2027, file 2026 is 0.1% increase. So Iowa normally excludes the retirement income, that is pension, IRA, 401k, Social Security benefit. You know how Social Security benefit you sometimes if your income is high, you pay some taxes, right? But Iowa no. So for taxpayer age 55 older, you don't normally get into Social Security benefit until you are retiring. You are not of course some kids get that because parents passed away early. So with that said, you know that Iowa tax is flat rate, and seniors kind of walk free on their capital gain kind of income. So Iowa has also doesn't have the estate tax. We'll cover that later. So this flat rate really helps the rater, right? If you make a lot of money to stay in Iowa, that's a pretty good deal, because it doesn't matter how much money you make, you still just pay 3.8% or 3.9%. What about Wisconsin? Wisconsin use graduated personal tax rate. It is starting from 3.5, go all the way to 7.65. So obviously, the average is about 4%, right? 4.5%. So basically, we can kind of conclude that the Wisconsin income tax is heavier than Iowa. Capital gain is also taxed as an ordinary income in Wisconsin. So Wisconsin allows some exclusions, 30% to 60%. So there's some exclusions to the capital gain, but they do still make you pay from 3.5% up to 7.65%. So Wisconsin do not impose the state estate taxes. Later on, we'll mention that. So basically, you can tell if you make more money, you're going to pay more taxes, right? 7.65%. So Wisconsin income tax, to me, it is very much like how Iowa was before January the 1st, 2025. But right now, as we speak, Iowa taxes is definitely better than Wisconsin. If our life is so simple, if people's life is so simple, they can just go with the flow of taxes, then half of the Wisconsin going to be moving to Iowa, right? Because it's lower taxes on income tax. But not so. People stay in Wisconsin or stay in Iowa for employers. So business is important. They are cornerstones for each state to anchor the residents, to create economy. So you kind of can see it is not as simple as taxes, right? So the tax people tend to make it is so simple, but it's not. The key strategies we want to mention to you here is the bracket comparison. You want to pull out your income, look at the $20,000 in Wisconsin, how much you pay versus $20,000 in Iowa. Retirement plan, Iowa is generally more favorable for retirees, so because they don't tax you on that. And if you have a multiple taxes, the state taxes to deal with. For example, you live in Iowa or Wisconsin, but you have businesses that in New York, Florida, and other things, so it is pass-through income to you, then you still have to deal with the local taxes. But both Iowa, Wisconsin have income tax, so you're aware of that, right? How about business income tax? Of course, when we talk about business income tax, we think of the S corporation and, partnership company. Those companies pass their income to the shareholder to be taxed at wherever the shareholder is sitting on, right? So if the shareholder is in Iowa, business in Iowa, then K1 goes to the shareholder, then pay 3.8%. But if it is Wisconsin, the shareholder has a lot more income, then it's going to pay 7%. So those are the things you want to remember. So the pass-through, at the end of the day, you still talk about the personal rate. But what about business that is a C corporation pays taxes on its own? Iowa imposes 7.1% on C corporation taxes in 2025. And the pass-through entity, of course, goes to your income tax rate. So Iowa is generally favorable for service business and close-held pass-through entities seeking rate stability. So here, you hear me saying that Iowa is favorable for service company. Maybe you have heard of Microsoft establishing place in Iowa. So these insurance companies are in Iowa. It is for a reason, right? They don't have inventories and they don't have anything. They have service. So service companies are generally do better from tax standpoint in Iowa. Iowa service company normally, at least the medium size service company are all pass-through entities to the personal tax return. But if they are C corporation, they pay 7.1%. But what about Wisconsin? Wisconsin is a 0.8% more than Iowa. So personal tax is more, right? We are at, Iowa at 3.8, but Wisconsin, can go up to 7.some%. So now with the company, it is also higher. Of course, the pass-through entity income goes with the 7.65%. But Wisconsin offers industry-specific credit. That is good to be noted here. So that is manufacturing and agriculture. So I want you to kind of remember I said that in Iowa, service company are doing better on taxes. So in Wisconsin, it is the manufacturer and agriculture doing better. So the type of business that qualifies for Wisconsin credit I'm muting my phone. So the kind of business that qualifies for Wisconsin industrial credit eligible, certain credit that eligible to certain industries. So these are the one: manufacturing, agriculture, and the farming. Research and technology also is a one. Economic development and the job creation. This one, Iowa has it too. Iowa has this economic development and job creation as well as a tax credit. And investing in development zones and relocating to Wisconsin are also enjoy the Wisconsin business credit, tax credit. And of course, community development and rehabilitation, those are Iowa has it too. So some of those encouraged industries, Iowa, Wisconsin are equal. But in terms of who is leading what, Wisconsin leading manufacturing and agriculture, and Iowa leading service company. So with that said, when we think of move or not move, and you want to select your entity type, right? You want to select the entity type that gives you the least tax burden, tax liabilities. And you also want to make sure that when you have a company, say you have a company in Wisconsin, but part of the sales is actually generated in Iowa, then you should do the proportionment properly, right? To make sure Iowa taxed in Iowa, Wisconsin taxed in Wisconsin for business purposes. So, of course, the owner's salary is also a thing to consider, because you want to make sure that if you are in Wisconsin and whatever W-2 you pay to yourself, it is already added to your personal tax, graduated the income tax rate. But in Iowa, made no difference because it's a flat rate. So give you example, John. John has a W-2 and also have a S corporation. W-2 wages $150,000. S corporation made a $20,000 net profit. Okay, filing status single, standard deduction assumed, so we don't mess around with that one, and then no material credit and itemized deduction. So we're not gonna mess around with the business credit right now in this example. So if John's income is Iowa income, then Iowa taxable income generally begins with the federal taxable income, then subject to Iowa specific modification, right? Assuming federal taxable income is $154,000. Then Iowa taxes is 3.8%, so we come up with $5,850 that John has to write a personal check to pay to the state, because it is calculated that way to the Iowa. Iowa will fully convert to the flat rate in 2026. 2025 is already at 3.8%. Iowa applies no specific capital gain rate. Capital gains are ordinary income, and the retirement income exemption applies only to retiree older than 55 years old. So this is Iowa. We highlighted it's a $5,850. Let's look at Wisconsin. And right here, because Wisconsin is a graduated rate, so we calculated a range. It's $7,500 versus $7,600. So you already remember we have $5,860, right? $5,850 in Iowa, but for Wisconsin it's $7,500. So it's quite a significant increase for John's income. Can you see that? So this is where we want to, have you understand how that was calculated. Now, we touched on income tax, personal and business. Iowa, Wisconsin, we compared it. And we kind of know that for John, who has a W-2, also have a K-1, and ended up paying 3.8% for Iowa, but, literally about $2,000 some more for the Wisconsin on income tax side. Now, what about sales and the use tax consideration? Sales tax in Iowa, we mentioned this before, our base rate is 6%, right? And then the local government can add 1%. So the typical rate is 7. Of course, groceries is exempted. You don't pay sales tax when you buy rice, right? So basically, anything you buy on the food stamp, you know how people get the food stamp? So anything you buy for the essential food item, you don't have sales tax. Okay? Sales tax impact consumption, right? So if you spend $80,000 in a year for food, it impacts for food and household item. It impacts the amount that you would pay. And Wisconsin imposes a 5% state sales tax, and with most counties at 0.5, so they're at 5.5. Certain place like Milwaukee imposes additional taxes. So Wisconsin's base sales tax is lower, 5%. Okay, though combined could exceed with what Iowa local combined. I mean, just depends on where we are, what we're talking about. A lot of times when a business start operating before they do, so those tax analysis has already been done. So the management actually know exactly what they're going to be paying more or less when they move to the new place. So example, what we give you is John household expense. Annual taxable household spending is $80,000, let's say. And this $80,000 includes furniture, appliances, electronic, household item, and all of these things. We're not worried about those ones who doesn't pay sales tax because we want to use a number to compare. So you can see that the state sales tax 6%, that's Iowa, right? And then if we assume average combined rate is 6.9%, then we have 80,000 times the assumed average rate. So the Iowans pays $5,520 for the $80,000 spending. In Wisconsin, for the $80,000 spending, the sales tax rate is $4,400. So you can see they are actually result in about 1,100 annual tax savings out of the $80,000 total spending. So that there is a difference, right? Just because the rate is different. We're at 7, they're at 5.5. So significant difference. All right. Property tax considerations. Now we talked about sales tax. So for businesses though, you know, if you are getting things in and resell it, when you are acting as a wholesale, there's no sales tax on both states. So when we talk about sales tax, is really at the end user, right? When you consume those taxable things like furniture, for example, then you pay sales tax, right? So that's what we are talking about. Property tax consideration. When we talk about property tax in our webinars, we always cover two things. One is the real property tax. The other one is personal property tax. Okay? So, you know, you may say that, what is the personal property tax? Personal property tax are everything that you can touch and feel and you move around. It's like your furnitures and things like that. They are personal property. The personal property can be imposed taxes as well. It's also called property tax. So in Iowa, residential property, we're talking about a real property here, is assessed every year on January the 1st and for a percentage. So that way you can pay property tax at the graduate increase if the value of the property go up. If the value of the property go down, then you pay less and less, right? So Iowa assesses their residential property every year. So they don't backlog the value. Not like California. Remember California? California doesn't really assess every year. They only assess when you have a special event, like you sold your house, right? And, I don't know whether I mentioned to you, in California, our office building in California, the seller who sold to us, like I think he got it like in, I forgot the years. The seller is 90 some years old, and she owns the property ever since she was young. So the property tax was literally $9,000. But after the new purchase, it would increase. It is actually increased by, I want to ask you, what do you think it is increased by? 5 times. 5 times. So that's a triggering event, right? So California is doing that. Iowa is doing it annually. So it doesn't matter you hold the property for how long. As an owner, you are being assessed annually for the new value. So the property tax continue to increase. Then the property tax is right around 1.2% to 1.6% of the property assessed value. So that's how Iowa property is. But in Wisconsin, the property is assessed market value as well. And it is periodically assessed, annually assessed. Okay? The effective rate is 1.5 to 1.8. You see, it is higher. It is higher. So both states has relatively significant property burden because they evaluate it every year. And the Midwest norm, which should be factored into relocation or investment decision, is to have the property reevaluated annually, paying new property tax all the time. So you just kind of now know that on the property side, they're very similar, right? So Wisconsin is higher not because of they do assessment more often. It is because their rate to begin with was about 0.2 to 0.5 more than Iowa property tax. What about you have residential property in Iowa that related to homestead exemption? So Wisconsin also has homestead exemption, but their exemption has a very narrow coverage because they say that you don't have the homestead exemption if you are highly compensated. The threshold is very low when you are considered high compensated. Maybe I should say when you are low income, because $24,680 of household income is nothing. People won't even have enough money for food if that is the total income of a household of 4, right? So really, the Wisconsin offers homestead credit to the low income people, and Iowa offers homestead credit to reduce the homeowner occupancy of the property. So if you bought a home and it is your primary residence, you can get homestead exemption. So it doesn't really have any income reference at all. It is more of you bought it. But if you are 65 years and older, you may even qualify for additional homestead exemption of $6,500 assessed value. So that is where the real property is at when you are with these two different states. So what about personal property tax in Iowa, Wisconsin? Remember I mentioned, in property tax field, it is not just the real property, it's also personal property. Iowa does not impose a general personal property tax at the state level, okay? Instead, Iowa just say that, you pay it through sales tax. They don't really, they're not going to, tax you on your inventories, on your if you own a nail salon on your salon tables. So they just want you to pay sales tax. With Wisconsin, there is a law called 2023 Wisconsin Act 12. Wisconsin imposed in the past, before January the 1st, 2024, Wisconsin imposed a property tax on both real property and the tangible personal property. But they're not doing that anymore. In that regard, they're similar to Iowa, so there is no personal property tax to pay tax for. Now, let's look at John's $600,000 residence home. The average effective property tax rate in Iowa would make him pay $8,400 taxes. So if John is older, then he will get even more. But this is the taxes that he's supposed to pay, $8,400. In Wisconsin, the same thing. It will be $9,600. So there is $1,200 difference. So basically, property tax on a equivalent home are often higher in Wisconsin on property tax versus Iowa. That's how generally speaking. Of course, now we are heading towards to estate inheritance tax consideration. Just keep in mind right now when we talk about these things, we are talking about the state, right? You can view state as another government that is sort of, disengaged with the federal government. So the federal government has this estate threshold that is $15 million, right? But the state can impose the same or can decide not to do any. So here, Iowa and Wisconsin, related to estate inheritance tax, the rules goes that Iowa fully repealed that taxes in 2025. So if you're gonna die in 2024, I'm just kidding, nobody can go back in time to die, but if you died in 2024, you still have an inheritance tax. But since January the 1st, 2025, that is gone. Estate tax never had it. So that's how Iowa is. And Wisconsin the same. No state estate or inheritance tax. All right? So estate planning in both states is driven almost entirely by the federal law because it's just the federal taxes. It's not really state. But Iowa remove the linear multi-generational planning friction. So Iowa did it more clean. Iowa actually completely let go with this part of the tax authority and then letting the federal government drives everything. So if you die in Iowa, you really don't have anything to worry. You just know that you need to work on the federal tax side, but not the same. If you die in other state, they may have a different requirement. But Wisconsin is the same as Iowa, so you can be comfortable. Oh, I noticed that my slides didn't change the Cali and Texas consideration because my last seminar, I was talking about California and Texas. So this is Iowa, Wisconsin. All right. Now, we had a kind of general look from personal taxes to business tax, income tax, and from sales tax all the way to property tax. In the property tax, we covered real estate property tax and also personal property tax, right? So now let's kind of understand residency, because as a taxpayer, you would have to decide where do you reside. Of course, you reside in U.S. I know you are not out of the country, but which state do you live? That is a residency issue between any two given state or even multiple states, because you can get the case to be so confused. Some times ago, I had a case where the gentleman works as an executive, highly compensated executive in Iowa, Des Moines. He works in the insurance company, highly compensated. But his family is in Maryland. So his wife and kids are in Maryland, and he lives in Des Moines, Iowa, and he stay in Des Moines from Monday to Friday, on the weekend fly back to Maryland. So this is his lifestyle for years and years. So the two states are fighting over the income taxes, trying to figure out what does he own, what he doesn't. So, at the end, there's a determination coming in. And we work the case, so he eventually become Iowa residents. But the reason that can be done is because of these reasons. So there are domicile factors that really matters. Like you got to have them to prove that you're a resident of one place, not the other place. For example, the voter registration, driver license. For example, where you generated your income from. For example, and which one is your primary residence? In our case, the executive also have a house he purchased here, because sometimes the family would come over, like especially summertime, then they will be all in Iowa. So, depends on where he declared that is a primary residence or not. Then voter registration, driver license, and where the money come from is of course come from Iowa, because he's a executive in Iowa, right? So then the family location. So this is where there is the argument. So the two states need to work it out. So eventually he of course become an Iowa resident, which is only fair, because basically 2.5 of those points, there are 4 points, but 2.5 are kind of indicating that he's Iowa resident. So with that said, it just tells you that residency is an important issue. If you moved, you want to make sure that you got your voter registration done, you got your driver license done. At least that gives clear indication of where is your home, where is your tax home, right? Then the rest of it, where your business operates, or whether you really stays here, then that will be other measures coming in. And of course, if you don't even stay in Iowa for at least 183 days, then why would you declare Iowa to be your residence, right? So with that said, I want you to know to provide clean document of domicile. It is essential for the screening, for the state audit. And, of course, the most aggressive auditor for the state is still California. California is very thorough, very aggressive in terms of determining your residency. So if you're their residents, you pay their taxes, right? With that said, I just want you to know that, determine the residency. You could be partial residents, but determine the residency is important. All right, so strategic takeaways. So here are 2 more slides related to that. So from what we have seen, Iowa may be more tax efficient if you are comparing that to Wisconsin, right? For high W-2 income earners, you only have a flat rate. Retirement income, if you're older, is not paying taxes. And it is simple. It is straightforward. And Wisconsin may be preferred if you have a business that is a manufacturing business or agriculture operations, because those have a lot of state-generated tax credit to come in to help you. I actually noticed that myself, because when we work with clients between the two states, we have a lot of Wisconsin residents are also naturally farmers, because they actually do some farming within their acres, a flower farm, sweet potato farm, ginseng farm. So we have seen all of that when we are working with Wisconsin. Now, you know why, because they have the tax benefit for doing these type of business. The move or not move, the bottom line from the pure tax efficiency point of view, Iowa wins over Wisconsin. But Wisconsin has a lot of businesses going on, and especially medical practice out there and the IT industry out there. So there's reasons why people are in Wisconsin, because the business is in Wisconsin. While you may say that, then if that's the case, why business is in Wisconsin? When a business relocate to Wisconsin, they also get benefit. They get tax credit. And, Iowa does the same thing. They allocate a big insurance company into downtown and give them 10 years property tax for free, right? So those are the things the state government, local government can do. They are focused on bringing the business in, because when the business is in, people are in. Doesn't matter you're good or bad, people will live in that state. So make sure that relocation, move or not move, is not just about taxes. It is really about life overall. And if you have a specific designation to go to and wanting to know whether that's tax efficient or not, what you should know, then you engage us and we do the analysis for you. We're so good at move or not move. But of course, not all of our clients will listen to us anyway, because we only talk about the tax side. The client might move just because they're falling in love with the other person in the other state so badly. They don't care about taxes. They can just drink taxes, they would still go there, right? So we're humans and not machine. Robot will make a decision easier for us than human making humanized decision. All right, these are your human partners. So none of us are robots, so we do have our temperament, if you call it temperament. We care about our clients. So if you want to talk to us, you can go to our website, communitycpa.com. Just click that appointment button. You will come over here. And when you are here, and each one of us heading a different area of specialty, so you can engage us and have a video call, video meeting, engage us to be our client. We always welcome new clients, and especially if you are sitting there just crying about paying too much taxes, or can't even borrow enough money to pay your taxes, then you're my clients, as I said, should come to us. I will see you again on Tuesday. Bye-bye.